Rohit Srivastava is with us. Rohit, appreciate your time. Oil prices saw another big sell-off. So I think they're at what, 2-year lows? Coal prices are at the lowest since they have been in 2009. And many other, actually everything except aluminum is looking pretty weak, has been looking pretty weak. Year to date, prices are down anything between 5 to 25%, depending on what you look at. Iron ore, for example. What's going on, Rohit?
Yeah, we have this very macro trend going on, which I think we've discussed many times before, and that's the dollar rally. The dollar rally has been around for several months since the euro topped at 1.38, 1.4. It formed what we call an ending diagonal structure from there. And it's been falling, and the dollar index accordingly had been going up. And initially, since it was driven only by the European currencies, I think people didn't take note of it. But right now, as I see and look at the basket on a daily basis, it's shifted to all other parts of the world. So you're seeing an across the board move up in the dollar against various currencies. And in that sense, I would say the USD INR is usually underperforming because if you look at the real, it's already crossed the high which when the rupee was actually 69. So putting that in perspective, what happens with commodity markets is that till the dollar index was subdued, you did see a small rally in commodities up to March. But after March, we've seen this continued sell-off in commodities. My sense is it's not over because the dollar rally is not over. And the downtrend in commodities is likely to continue. And it's almost spread to every part. For some time I thought maybe the agro commodities would hold out, but those also sold off after May of this year. And therefore the entire commodity basket, whether it's agro commodities, base metals, precious metals, all of them are in downward trends for at least some time. The only one that I would be watching most closely is probably the precious metals pack, because somewhere whenever you get a correction in US markets, you do see buying come into that one segment. So that's one segment that I would watch out for. But in general, I think we are looking at some more downside, at least for the next couple of weeks in the commodities place.
Okay, so it's basically dollar rise led. It's not essentially reflecting weakness as far as demand goes, Rohit, right? I mean, maybe some of that, but majority of it is dollar weakness, dollar strength.
The strengthening dollar does have the most direct impact, or it's the easiest thing to correlate. There are other possible reasons, like what you mentioned in terms of demand. Yes, there may not be a slowdown in demand, but I think for some time we've been hearing about that there's a lot of capacity, especially in China and so on. So I don't have exact data on it, but that could be one of the reasons that while demand is growing more slowly, you have a lot of capacity. So that may be one of the possible causes, but it's hard to pinpoint. But the dollar rally is a glaring one, which we can easily pinpoint and say that's one reason that you're getting this move.
So what does it mean for equities, Rohit? This big dollar breakout that we're seeing?
Yeah, see, a lot of it gets associated with, whenever you see the dollar run up or you see US treasuries run up, it's related to risk being taken off the table. Then the question becomes exactly where is risk being taken off the table? So commodities is the one that took the first hit, which usually we expect it to be the last or lag equities. But we are seeing it go down first, which means equities could be behind, and especially if money is flowing back to the US, the dollar strength is essentially showing that money is moving towards the US side in a risk of trade. Then the first hit actually is happening in equity markets which are non-US. So if you actually scan say 10 to 15 equity markets on a daily basis, which is something I do every morning for a couple of hours, you actually see it happening market by market. So if you saw a couple of we've been hearing about Russia. So the Russian market fell, it bounced back a bit, but it's again made a 2-month low in the last 2 days. We've seen then it shift to Brazil in the last month. Australia has been one of the weakest performing markets of the last 1 month. So you're seeing one by one many markets start to weaken. Hong Kong, for its own reasons, started to do that. And in that sense, I think US equities has held out the best. But I think in general, it means that you are going to see pressure building up on equity markets around the world. We are seeing some of that build up in Europe as well. US might appear to be the strongest, but I think should also be seeing some kind of decline. But other markets would be weaker than the US is what my sense is looking at the dollar breakout.
Rohit, I think we discussed this earlier, right? So what happened between 2000 and 2009 when dollar actually was weak? S&P largely was, doing what the dollar was doing. I mean, it didn't really do well. It actually did quite poorly. 2009 onwards, till recently, the dollar actually has been doing nothing. It's actually been flat. And US equities have done phenomenally well. Now, the correlation between the dollar and the S&P between 2000 and 2009 is not just for that period, but it's essentially a straight relationship if you go back the last couple of decades as well, right? The direction of the S&P and the dollar has been largely in the same direction, up or down. But 2009 to now has been actually a break where the dollar hasn't gone anywhere. US equities have done very well. With this strength in the dollar, how do you think it's going to play out? Are we going to compensate for the recent rise, or the earlier trend will come and take hold of the market where the dollar appreciates and equities also do quite well? US equities.
In each period of time, the reasons for what happened are different. If you go back to the early 80s, the dollar was pushed down for a particular reason, and then they raised interest rates to keep it from falling because they had very high inflation. So the dollar strength was actually went along with rising equities for quite some time. Usually that is the trend. We've seen it for the last 1 year also rising. I mean, the strength in the dollar as and when it's been there, even the little bit that was there, we've seen US markets do well. But what we are seeing right now, when you look at the stronger dollar, is essentially you're seeing various other economies which are not doing so well, whether it's Japan or whether it's Europe, actually weakening their currencies. So most of us are essentially looking at the dollar index, which is a basket of mostly some large currencies, which is the euro, pound, franc, yen, the krona, and so on. So when you're looking at that basket and you see what they're doing is they're actually devaluing their currencies to strengthen their economies. So when you see the yen weaken, you see the Japanese markets actually go up. Similarly, Europe has also been talking about driving down the euro so that they can get a pickup in their own economy on the export side. And the question in my mind is how long does everyone else sit back and let this go on? Because a large part of the emerging world or the Asian economies which are export driven essentially are come under pressure when they're competing with everyone else. So far they've probably not felt the heat because weak currencies can be positive, which is what we've also seen, that despite weakness in the rupee, markets actually ended up doing very well. People would, if you told them at 50 rupees that the rupee would go to 60, they would say that means the end of the world. Well, we are at 60 and the market is at 8,000. So exports is essentially the key area that is affected by this dollar rally, especially when it's driven by various other countries that are devaluing their currency. So essentially what you're seeing is the start of a potential currency war between various economies that want to stimulate themselves, and that can have different implications. It can get notorious. So you really need to watch what is going on there. But if you're in the currency markets as a trader, or if you're allocating assets, I think this is one of the big trades for the year. Its implications can completely vary depending on how everyone else behaves on the economic side.
For India, Rohit, I mean, the almost consensus view is, well, buy the dips. The bigger the dip, the better. Do you agree with that, Rohit?
What has happened, if you just look at the last 3 months, and you're right, the consensus view is that it will dip, and even as I've called for a correction over the last, for the next 1 month, I think by Diwali, I'm expecting the market will probably go to 7,700 or maybe go to even 7,200. And most people say that's great, it's a buying opportunity. And it might as well be, but what is happening is that the sectors and stocks are getting extremely narrowed down. We've seen not only weakness but complete trend reversals in various stocks and sectors in the last 3 months. It initially started with just some of the banks, which is the public sector banks. It spread to realty. It's now spreading to metals and capital goods as well. So all of these sectors are not participating, and they're reversing, breaking their trends. A lot of mid caps also are breaking trends, and within the mid cap, small cap space, it's stocks in the cash market which have individual stories only that are doing well. So the upward trend is getting narrowed down to a smaller and smaller list. And as long as that is in force, it's possible that the Nifty still holds out, at lower levels and again moves up on the back of that smaller list of stocks. But it's not a good sign for the long term. It's not a good sign that you have narrowed it down so much. And if you're in the wrong place, if you're simply buying stocks thinking that the market will go up, you could be completely caught on the wrong foot.
It's a pleasure, Rohit, as always. Thanks very much for your time.